Okay, good afternoon, everyone. Again, this is Elise Bazzelli from the Connecticut Green Bank. Thank you for joining us for the Solar PV SIR calculator training. We'll get started here. If we could go to the next slide. So just a couple of quick housekeeping notes to begin. There will be breaks for questions throughout the presentation. So you'll see a slide come up that'll say questions, and we'll be able to talk through those in real time. So please use the chat feature to ask a question as they come up. Don't wait till the end of the presentation if something comes up. You know, if you see something come up that you want to ask a question about in the middle of the presentation. When we get to that questions break, we'll read the questions out loud, and either myself or VJ from ERS will be able to answer the questions for you. And again, can't stress this enough, we encourage any and all questions. We want to make sure that the training is very clear. We want to make sure that you guys have a good grasp on how the tool works so you can use it when creating proposals or when you're thinking about job prospects that might be a good fit for CPACE financing. We want to make sure that you've got these tools ready and that you feel confident in using them. So with that, we'll move on to the agenda slide. Okay, so just a quick agenda. I'll do a quick introduction to the Green Bank and to Energy and Resource Solutions. Then we'll do a quick intro to the savings to investment ratio, which I'm sure most of you are familiar with, but we'll kind of rehash what that SIR requirement is. Then we'll go through how to download the workbooks from the website. We'll do a project example introduction, so give you some key points that we're using in a live example, and we'll actually walk through the calculator, the data entry tool, and then we will review the results of that. And then at the very end, we'll make sure that you have the contact info for our partners at ERS. So with that, we can move on to the first introduction. So again, I'm sure you're all familiar, but the Connecticut Green Bank, we are a quasi-state organization with the general goal of trying to deploy as much clean energy as we can in the state through administering various programs. And we do that by leveraging public dollars to try to attract private capital investors into the market. And the main financing program that we have available to commercial properties is called CPACE. And the CPACE, one of the CPACE requirements, one of the statutory requirements of the program is that projects need to meet a positive savings to investment ratio, which VJ will talk about in a few minutes, but basically making sure that a project is going to save more money than the building owner is actually going to spend on their investment. So if we could go to the next slide here. So the Connecticut Green Bank, we're the administrator of the CPACE program in Connecticut. And Energy and Resource Solutions, or ERS, they are our technical administrator for the CPACE program. They also do all of the underwriting, the technical underwriting for the Green Bank financed projects. And our leads, the CPACE leads at ERS are Satyen More and VJ. I'm not gonna attempt it, VJ, but I'm gonna actually turn it over to VJ now, and he can walk through the rest of the presentation. So VJ, take it away.
Great, thanks, Elise. So as Elise kind of mentioned in the introduction, the Connecticut CPACE program guidelines require that projects achieve a savings to investment ratio, or SIR ratio, that's above 1. Which essentially means that over the life of the project, the total cash inflow should exceed the total cash outflow. And the cash outflow includes, the cost of the project or cost of the measures, in addition to the financing fees, closing fees, and other things. And the savings can include the energy savings, income tax credits, depreciation credits, any available cash, really value streams. So the total inflow greater than total outflow, that's the goal. So the Connecticut Green Bank has made two SIR calculators that are available for contractor use. One is a solar PV SIR calculator that we'll be going over today, and there's also an energy efficiency and solar SIR calculator that we'll be going over on Thursday. So with that, I'll move on to how to download the workbook. So I'm going to quickly walk through the steps, and then I'll actually show you the steps as well. So you go to cpace.com and click on the Contractor link on the homepage, and then you click on Resource Center. It's the option at the top of the page, and then you'll see two calculator options. One is the Solar SIR, and the other the Energy Efficiency plus Solar SIR calculator. And when you click on either of these calculators, an Excel workbook will begin downloading. So as I mentioned, here it is. So this is cpace.com. So you just click on Contractor, and then from there you go to Resource Center, and under Resources for Contractors, you have the Solar SIR calculator, which once you click on it, it'll start downloading, and then the Energy Efficiency plus Solar SIR calculator. So that's a quick how to download the SIR calculator. So I know that was first step was just downloading the calculators. We wanted to make sure that it works for you if you're trying to follow along, and see if you have any questions before we move on. All right. So the example project that we're going to be talking about is a commercial facility that's eligible for income tax credits and maker's depreciation. So that's accelerated depreciation, that currently uses 200,000 kilowatt hours per year. The proposed solar PV system is a 125 kW system, and the facility is located in Bridgeport, Connecticut. The PV system is expected to produce 150,000 kilowatt hours in year one. They have acquired a ZREC contract at $98.18 per megawatt hour. As you know, one ZREC is equal to 1 megawatt hour. So the installation cost is $300,000. And the project expected useful life is 25 years. That's the PV system life. So the standard inverter warranty is 12 years. The extended inverter warranty that's included in the $300,000 installation cost is 20 years. And then on top of that, in order to extend the life to 25 years, which we'll go over in more detail as we're entering data into the workbook, you can include an inverter replacement cost in year 21 in order to extend that life. So this is just a quick summary of the project that we're going to be going over. So before we dive into the spreadsheet, does anyone have any questions? All right. So we kind of move into the live data entry section of the presentation. So this is the solar PV tool. So first I'll go over all the tabs that we have here, and then I'll dive into the inputs. So there's a README tab that essentially goes over some of the details with respect to how to enter the data, where to start, what the various color schemes are in the spreadsheet, and things like that. The second is the inputs tab, which is where almost all of the data entry that we'll be doing, or the contracts you guys will be doing, is. It's right here. The simple CPACE SIR model tab is where the calculations take place for cash inflows and cash outflows. There's only one row in this entire tab that you will be filling, which is the inverter replacement cost if necessary. The cash flow chart, so once we populate the project, you'll see the cash flow chart. Actually, this you can use directly in your marketing material if you would like, but it just presents the cash flow over 25 years and allows you to visually look at how the project plays out once you enter the data. And then we have a utility bill example. So the utility bill example is just how to calculate the tariffs and things like that we'll go into detail on. In addition to that, we also have summary tables, which is just a summary of the project. You'll see that. And then a summary of the PV measure, which is where a lot of the energy-related calculations occur. There's no data entry for that particular tab. There's a closing fee calculator tab. The closing fee calculator tab is how, the CPACE, when you go for CPACE financing, there's a closing fee associated with that financing. So this shows you how we calculate the closing fees. The tax benefits calculate the income tax credits and the maker's depreciation. The principal and interest tab shows you how, what the cash outflows are, or the cost of the loan essentially over the life of the loan or over the term. And then finally, the interest rates, just a list of, for every term that you select, what the corresponding interest rate is. So all of this can be unhidden and you can take a deeper dive into that. But essentially, the only tabs that you need to enter information into or modify in any way are in yellow: the inputs tab, the simple CPFSI model, and the cash flow chart tab. These are the three that you'll be dealing with as you go over. So with that, we'll start with entering some live information. So let's go with today's date. So this is 8/4/2020. So we have, let's just go with street name, street address, city. We know this is Bridgeport, Connecticut. Let's go with zip code. Just going to make up a zip code for now. And then we dive into the annual electric use. So as I said in the project introduction, this facility uses 200,000 kilowatt hours per year. Now, this value comes from an analysis of the utility bills. So the utility bill analysis ideally involves the review of 12 actual utility bills. If 12 bills aren't available, at the very least, we should have one most recent bill or the most recent applicable bill that shows the usage over the past 12 months. If it's an Eversource bill in Connecticut, typically that does include the previous 12 months worth of usage in kilowatt hours. And if it's a UI bill, it most often includes a kilowatt hour per day metric that they show you for the previous 12 months. So you can use either of those and come up with the annual usage, ideally 12 months worth of bills so you have for review. What's important to keep in mind is that this should represent typical operation. If there's been any major impacts in the previous 12 months that result in the facility not using energy like it typically would, you should go back to the period of time when it's most representative. Next, we go into the energy and cost inputs. So that's the electric utility. Now, as I go over this section, I'm actually going to move over to the utility bill example tab and walk through how we calculate the avoided cost, or the dollar per kilowatt hour avoided cost for solar PV projects. So that we go to the utility bill example. So as you can see, this is a UI bill. So that's the electric utility. And the transmission distribution rate is general service. Now, to begin with, we're going to break this down into dollar per kilowatt hour and dollar per kW. So this represents the electric energy usage, and the kW is the demand charge. For solar PV projects, we don't include demand charges as part of the cash inflow because, as we know, this is a transient source. And so the demand is typically set over a 15-minute window throughout the month at any time during the month. And if the peak demand is set during a 15-minute window where it was cloudy and the solar PV system for some reason wasn't quite producing, then you don't get the benefit of demand reductions. So in order to be realistic and careful with how we calculate cash inflows, we don't include the kW charges. We only include the kilowatt hour charges. So with that, we go into the actual bills. So we see there's a generation services charge that's in kilowatt hours, and that's about 7.35 cents a kilowatt hour. So we include that in yellow, which means it's a kilowatt hour charge, as we saw right up here in yellow. Transmission per kilowatt hour, there's no charge associated with that from this particular bill. Distribution per kilowatt hour is about 1.36 cents a kilowatt hour. There's a combined public benefits charge of about 0.93 cents per kilowatt hour. And there's a non-bypassable FMCC per kilowatt hour charge that is not applicable for this bill. And then finally, a decoupling adjustment that's actually a credit of about 0.089 cents a kilowatt hour. So what we do is we go back up here and we see we added all of those various components up to come up with what the avoided kilowatt hour charge is. So this is the value that we'll actually use to calculate the cash inflow. And not an all-inclusive dollar per kilowatt hour, which would essentially be the total charges. That's 2,053 divided by 12,560 kilowatt hours. That would give you 16.3 cents a kilowatt hour, which, as you can see, is significantly higher than the 9.6 cents a kilowatt hour that we'll be using for our calculations. So Actually, this might be a good point for me to pause and see if there are any questions about the utility bill section. Okay. So the electric utility, so as we saw, this was a UI, was the utility. The electric tariff was general service. The electric cost is 0.096 cents a kilowatt hour. So that's $0.096 per kilowatt hour. We use an annual escalation rate of 2.99%. This applies across the board. This is default. That's what we use. And then the wholesale electric rate, that's if your total generation for your PV system is higher than the total annual usage, you're exporting some of this energy. So we apply a 4.5 cents a kilowatt hour rate to that exported energy. That comes from a historical analysis of ISO New England data. So again, those two are default inputs. For financing inputs, we will come back to the CPACE term right after we finish a few other inputs, and soon I'll explain why. So let's move on to the tax and depreciation inputs. So the counting investment tax credits, as I said, yes, this facility is commercial and will be including that, and the maker's depreciation will also be included. The property owner's marginal tax rate. Now, this is going to be specific to each facility, as you can imagine, but in general, we use a default of 21%, but we've seen anywhere from 21 to 35% being used. So really, you got to look at facility-specific inputs for this, and 21% is the default. So moving on to the system size in watts DC, it's a 125,000 watt system DC with a first year generation of 150,000 kilowatt hours. Now it's important to note that you can use any solar PV simulation tool. We've seen PV watts, Helioscope multiple being used. We typically use PV watts as our cross check to make sure we're in the same ballpark as what the contractors come up with. And if we're not, then we try to figure out what the differences are in inputs and try to reconcile. And if not, then we'll reach out to see if if you can provide more input on why our numbers are not lining up. But typically these numbers line up pretty nicely. The solar PV project cost, this is about $300,000. There is no roof structural improvement cost as part of this project. The REC value and the quantity of RECs. So next, I'll show you how to find the REC value and the quantity of RECs in an example ZREC contract. So this is a small ZREC contract, and right here at the bottom, you'll see the maximum allowable quantity. That's the maximum megawatt hours that you can enter for the ZRECs, and the purchase price is the dollar per ZREC for income. So that's $98.18 per ZREC, and 156,000 kilowatt hours or 156 megawatt hours is the maximum ZREC allowable quantity. So right here in the REC value, we enter 98.18, and in the REC term, in the quantity of RECs, we enter 156 megawatt hours. And the REC term is typically we default to 15 years, but if let's say there's a project where the ZREC was acquired early, but there was a delay in the project in generation, and of this while you're putting this calculator together, you can use, let's say there's a 1 year delay, you can use 14 years or 13 and a half years if that's what's appropriate, but typically it's a 15-year term. Next, we move on to solar PV module performance warranty. So this, I'll show you an example cut sheet. We're not talking about any specific products, but this is just an example of a cut sheet and the warranty. So the 25-year linear product performance warranty is what we have here for this particular solar PV module. So it's a 25-year module warranty, and that's what you would enter right here. Solar PV module performance warranty is 25 years. And then inverter standard warranty period. Now this, as you know, depends again on manufacturer and which inverter it is, but an example of where you can find that is in the limited product warranty document. So, just zooming in a little, under inverters, you see there's a 12-year warranty on the inverters. So that's what we'll enter right here as the standard warranty period for the inverter. Inverter extended warranty period depends on whether or not an extended warranty is purchased. In this particular case, the cost of the project includes an extension to 20 years. So the inverter extended warranty period is 20 years. Furthermore, the contractor indicated that the expected useful life, they'd like it to match the solar PV module, which is 25 years. So in this case, you could enter 25 years. And in the simple CPACE SIR model tab, there's an inverter replacement cost option right here. So in year 21, you would include a negative $10,000. That's this particular charge for this facility to raise it to 25 years. So this would increase the EUL, or the expected useful life, to 25 years. So we're going to run this project in two different ways. One is defaulting to a 20-year useful life without the extended warranty. So we're going to start with that. So let's say it's a 20-year warranty. There's no inverter replacement. And we'll also work this project out in 25 years with the extended inverter replacement. Next, you have the solar PV annual performance degradation. We default to 0.5% for solar PV projects. The turnkey project cost is just a reference for us to see that it's in the ballpark. So $2.4 per watt is what we have, and a capacity factor of 13.7%. These two values are just for us to cross-check to make sure that the values are reasonable and within what we typically see. So with that, we have the expected useful life for this project. It's 20 years. That's the limiting factor here, is 20 years, because the module has 25 years, but the inverter is limited to 20 years. So the CPACE term can be anywhere between 5 and 25 years, but it can never exceed the effective useful life of the project. So if this is 20 years and you enter 25 years, it's going to turn purple and strike through because it's not an allowable input. So you want to be either 20 years or below. So we're going to start with 20 years right here. And as you saw, that turned yellow, which means it's accepted as an input. So with all of those inputs, the last inputs we need to go to are the financed amount inputs. So the project cost is $300,000. This is a commercial facility with no available grants. If it's an industrial facility, there is currently a grant available called Energy on the Line grant, but for this facility, there is no grant available. So it's going to be $0. So the total project cost is $300,000. The owner equity, if let's say the owner wants to put up some cash up front, you can enter that here. In this case, there is no equity contribution from the owner, so that's $0 up front. So the finance amount before closing fees is $3,000, and the finance amount and the closing fees are calculated based on the financed amount. So if you'd like to see in detail how that's calculated, there's a closing fee calculator where you can see the breakdown of the buckets, how that's calculated. So in this case, it's $9,000. So we have $9,000 closing fees, which totals to $309,000. So that's the total financed amount. So with all of these inputs populated, and we got to make sure every single field is populated, we can move on to the simple CPACE SIR model tab. So first, you have the annual electric usage in kilowatt hours. That's 200,000 as we saw in the inputs. The expected generation is 150,000 and degrades every year by 0.5%. The electric cost is 9.6 cents a kilowatt hour, escalates at 2.99% every year. And then the wholesale cost is 4.5 cents a kilowatt hour and escalates every year. In this project, because the annual electric usage exceeds the generation, the wholesale rate does not come into play here. So you have the energy cost savings, which is essentially here, in this case, a product of the generation and the electric energy cost. And you do that, you run that for 20 years because the effective useful life is 20 years for this project. So you run that for 20 years. The RECs are the renewable energy credits. Now they're going to be limited by whichever's lower, the maximum allowable quantity, which we entered right here. So that's 156, or the actual generation, which in this case is 150. So it's going to be limited at 150 for this project. So every year that's going to calculate based on actual generation for 15 years, which is the term we entered. The maker's depreciation is based on the 21% marginal tax rate we entered. That's calculated in the tax benefits charge tab. Sorry, if you're interested in looking into how that's calculated, it's all available. That's $54,000, $55,000. and then we have the ITC income tax credits of $78,000. So we have the total cash inflow over 20 years at the bottom right here. Moving on to the cash outflows. The base payments are at about $27,000 a year. This is based on the principal and interest calculation tab. Again, if you'd like to look at it in detail, it's available for you to look at. So that's every year for 20 years, which is the term that we selected. You can select anywhere between 5 and 20 years. So what we selected in this case was 20 years. There is no inverter replacement cost in this iteration of the run. We'll also include that in another iteration shortly to show you how that would extend the useful life of the project out to 25 years instead of 20 years. So the total payments are a sum of the base payments and the inverter replacement costs. And then you have the annual net cash flow, the net cumulative cash flow right here, and the simple annual SIR on an annual basis. So more to the SIR over the EUL of the project. The total cash inflow over 20 years is $713,000, and the CPACE investment is $546,000. So net savings to investment ratio over the life of the project is 1.31, which 1.307, which means that it passes the SIR test. So that's kind of how that's the value we're after at the end of the day. That's the guideline requirement of being above 1.000. So that's what we're looking for. I'll quickly move over to the cash flow chart in this case. So as you can see, this chart, you can adjust the axes to any scale that you'd like to show, but you can use this cash flow chart just to show the value of the project, over the life of the project to the customer or in any of your marketing materials. Going back to the inputs tab, let's say we want to extend the useful life of the system, PV system, to 25 years. We'd enter 25 years right here, which is the life of the measure that we would like, and we would go to the simple CPACE SIR model tab and go to the 21st year, and enter negative 10,000. So that's the cost of extending the warranty to 25 years. So with that, as we see, the cash inflow or the energy savings is calculated over 25 years, as is the total annual cash, total cash. I'm sorry, I'm back. I don't know what happened there. Yeah, I'm back, Elise. I'm sorry about that. I don't know what happened there.
No problem. We can hear you.
Just dropped. Yep. Awesome.
Wasn't sure if that was me or you. No problem.
No, it was me. So I'm sorry about that.
No problem.
So,
welcome back.
Back to the. Thank you. In year 21, we have a negative $10,000 inverter replacement cost, which extends the savings and the cash inflow to 25 years. And so with that, your total cash inflow over 25 years is $36,000. And if you want to keep the term at 20 years, you can, and that would be about $555,000. But let's say you would like a 25-year term, and some customers may choose to go for the longest term available. Previously, when we entered 25, it turned purple and struck through because it was greater than the EUL. But now the EUL is 25, so you can actually enter a 25-year term. With that, as you saw, the financing rate automatically changed to 6.5. And so the total, investment is increased to $640,000 over 25 years. So the savings to investment ratio is at 1.308 over 25 years. So you can choose the term anywhere under the expected useful life, and you can extend the expected useful life up to 25 years by either purchasing extended warranty and then including inverter replacement cost, or maybe you can, if the extended warranty purchase doesn't work for some reason, you can even include inverter replacement costs in years 13 and 21, or 13 and 22 if required. So it really depends on the product specific, the inverter specifications, and the inverter manufacturer availability of extended warranty periods and things like that. So with that, I will move back here and see if there are any questions.
Yeah, so we do have a couple questions, Vijay. So the first question is regarding if you have a project that includes batteries, does this sheet work for that scenario?
That's a great question. And batteries, if batteries are included as part of the project, that would go through the energy efficiency and FIR calculator sheet that we'll be training on Thursday. But that would not go through this sheet. So this sheet is strictly for solar only projects, not with batteries. With batteries, we'd go through the energy efficiency plus solar sheet.
Great. We have a couple more questions here. So the next one is regarding the ZRECs and the payments by the tax rate. So does this tool discount the ZREC payments by the tax rate?
It does not currently do that. So we include the ZREC income as is and do not discount it by tax rate.
All right, and finally, we have one more question. It appeared that the date on the top row of the simple CPACE SIR model was not editable and was fixed to start in 2019. And the question was wondering if there was a way to edit that.
That's a great point. So we absolutely can make that row editable so that you can modify the year that that you're using. Because that's a great point. No, we can make that editable. Thank you for calling that out.
That's all the questions for now.
Still got you, Vijay?
Sorry, Elise?
Yep, you there?
Yep.
All right, great.
So with that, here's our contact information. You can contact either me, Vijay Gopalakrishnan, or Satyan More with ERS if you have any questions as you're filling out this, the SI calculator, as you're working through it. If you come up with any questions or anything that's not working, anything like that, we're happy to help you at any time. So our contact information is on this page. Excellent.
Thank you, Vijay. And I will learn how to say your name one of these years, your last name. I promise. So thank you very much. This was excellent. I hope everybody found it informative. We'll give you a couple of more seconds here to ask any other questions you might have about the calculator. And while you're formulating those questions, I'll just also mention that this webinar was recorded, and we will make it available along with the efficiency plus solar calculator recording next week. So sometime next week, you'll see the recording come out. We'll also make it available on our website. So if you need a refresher, or if you have other members of your team that couldn't attend the webinar today, you can always direct them to the recording, and they can watch it and kind of walk through the template and use it if they need to. And of course, always feel free to reach out to Vijay or Sadi here. And as always, you can reach out to me. And I don't have my contact info up here, but we'll make sure we send that out along with the recording when we get those out next week. So with that, Rob, do we have any other questions coming through?
Nope, no further questions.
Okay, great. So I think we'll go ahead and wrap up here. And again, thank you all for joining us this afternoon. Hope you found it to be informative. And if you have any further questions for any of us, please feel free to follow up. Thank you all very much.